our usual companion to our weekly newsletter. Squirrel coming to you on the morning of Tuesday, October 1st, Melbourne time. Quick reminder to make sure that you get the show notes for charts and links. If you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. But as ever, before we start, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent, talk to a financial advisor. Now, this week's pod is China stimulus fireworks free. While the news has certainly been terrific for many of the Squirrel's favourite themes, and I'm certainly not fading it, we did not want to add to the many podcasting hours already dedicated to the topic. Instead, we're going to contemplate the outlook for the Surry Hills Canvanauts, not a sports team by the way, and whether or not some of the original SaaS, i.e. software as a service, unicorns might be in fact destined for the glue factory. Last Wednesday's long-form Bloomberg profile piece on Canva, the Sydney-born graphic design software unicorn, got the whiskers twitching for this rodent. There is a lot riding on this deal down under. Everyone from the largest super funds to the constellation of family offices in Sydney and Melbourne own this one and in size. And a lot of performance track records are built around its, so far only on paper, enormous valuation. For the past 3 years, Canva has promised to be the next Afterpay for Australia's startup and capital markets community. Faint echoes of the chinking champagne glasses celebrating the 39 billion Aussie dollar acquisition of the buy now pay later business by Jack Dorsey's Square in August of 2021 can still be heard in Sydney's Circular Quay. This is notwithstanding the fact that Square is down almost 80% since that acquisition was announced. Was Afterpay the deal that turned Square into Block? Sorry about that. The world of Australian private market assets is actually on a bit of a roll at the moment. June saw the Australian IPO market successfully reopened by Guzman and Gomez, ticker GYG on the ASX. The successful debut of the local answer to America's Chipotle Mexican Grill carries with it the hopes, dreams and prayers of the Australian private equity community and its supporting investment bankers after a multi-year deal drought. Well, they'd better keep their fingers and their toes crossed, as this purveyor of finest breakfast burritos to the nation's tradesman community, or tradies as they're called down here, is currently trading at the kind of spicy as a jalapeno valuation that will be unlikely to survive any execution slip-ups by management. To put that specifically, it's about 20 million Aussie dollars for each of their 200 restaurant outlets, translating into 9 times forward sales and a lofty 61 times forward EBITDA. I think some kind of collective willpower is what is keeping this valuation in the stratosphere. Afterpay's lofty $39 billion price tag, or $26 billion US dollars, also happens to be the same number as the most recent secondary private funding round for Canva. That took place back in May. However, it's the September 2021 print at $40 billion US dollars that is the one that really gives you an idea of the FOMO that was generated around Aussie startups by that Afterpay deal. According to Bessemer Ventures data, this puts Canva at the top of the Premier League of cloud unicorns, and certainly top of its design and collaboration subset in the private unicorn market. Now, regular readers will know that this squirrel tends to get pretty grumpy about what Prof G or Scott Galloway calls Silicon Valley's yoga babble, but I will let readers draw their own conclusions about the fact that Canva adorably refers to their 4,500, yeah, that's a big number, employees as, wait for it, Canvanauts. It also has a chief evangelist and a, even worse, head of vibes on the payroll. I can only imagine that there are plenty of labradoodles and beanbags everywhere at their hip Surry Hills headquarters. Whatever you do, on no account should you search for Canva Create Wrap on Google. Just don't do it. What I'm not, however, prepared to let slide for a company with aspirations to be a large US-listed public company soon is that it's currently missing a CFO. Public market investors are likely to require some first-class hand-holding to get comfortable around the financials and the company's heady valuation. Whatever the new, shall we call him or her, numbers Canvanaut, eventually gets on board, he or she will have at least a great story to tell about top-line growth. They've tripled monthly active users to 190 million since the dark days of the pandemic. I've not been able to review a detailed financial model, but there are a few nuggets of selected unaudited financials that are available online. Per Sacra, the growth in monthly users is purported to be generating annualized revenues of $2.3 billion in the current calendar year. I put some very basic squirrel valuation maths in the show notes. Canva's monthly active user growth is soon going to have to do some battle with addressable market physics. The valuation of May's secondary sale puts Canva on an enterprise value to sales multiple of about 11.5 times the rumored 2024 revenues of $2.3 billion and about 10.2 times my estimate for 2025. Now, those whisper revenue numbers also imply that Canva has an impressive 15% share of the $15.4 billion global creative software market. However, that is not the market share number that Bloomberg has come up with. They see Canva with a 4% share, and I've not been able to reconcile the two numbers. According to the same Bessemer data, just the design and collaboration and cloud startups have a collective valuation of $108 billion, i.e. 7x the addressable market in creative software sales. That addressable market also happens to have an incumbent and public £800 gorilla in the form of Adobe lurking in it. Gulp. When that particular large primate is installed on pretty much every PC and MacBook on the planet, building share from here could be a problem. A cursory review of Adobe's recent conference call transcripts will not make for great reading for the Canvanauts. To quote Ashley Still, SVP and General Manager of the Creative Product Group at Adobe, on a recent call, quote, "So certainly, we've had a look at some of the numbers that have been published by Canva, and it just validates the opportunity at the low end of the market." Ouch. And I'm afraid it's not just Adobe that is the potential problem for Canva here. I was all of yesterday years old when I realized that something called Microsoft Designer was bundled for free with the Squirrel's $99 a year Office 365 subscription. I had a play. There's even a demo in the show notes. Now, it may take a while to get used to it, and the functionality may not be perfect, but given that there's absolutely no way that I'm ditching Word, Excel, and PowerPoint, am I really going to rack up another SaaS subscription to mock up the occasional banner ad or social media post for Blind Squirrel Macro? Then I read over the weekend that Microsoft may now be planning to drop these AI Copilot 365 bundles. I wonder why. Is it perhaps because they're too expensive to be thrown in for free to this poor rodent? Canva's certainly been upping its game to compete with those AI-powered offerings from Adobe and the other hyperscalers, most recently with the acquisition of Leonardo.ai back in July. It feels to this squirrel like a defensive move, as some kind of AI Copilot feature appears to have become a minimum cost of entry to the creative software game, even if the features seem a little bit gimmicky. Now, I want to interrupt here for an important squirrel digression. I find it incredible that there is still not a consumer AI app that I've found that can convert HTML web pages, just like my research notes, into a usable, i.e. printable, PDF document. So much for AI graphics technology. Perhaps Hewlett-Packard has bought them all just to shut them down in order to maximize printer ink usage. Please note, this feature is definitely missing in my life, so please do get in touch with me if you know of a product that actually works. Email acorn@blindsquirrelmacro.com. Anyway, back to regular programming. These expensive-to-run AI features surely cannot be added for users without a possibly substantial additional charge. Does that see ARPU, or annual revenue per user, up, but also costs up by even more? There are already reports in the local press about customer pushback. This also presents a challenge for a business that is trying to increase its percentage of paying subs from the current 12% of monthly active users. a feat that looks even harder when you consider that a breakdown of Canva's current users does not look great in terms of potential propensity to pay. Its user base is dominated by schools, non-profits, and other organizations with an incentive to make do with PowerPoint and Google Docs if they no longer get it for free from Canva. Now, historically, an exit from the unicorn stable was for founders and their VCs to either IPO or sell to one of the large cloud services providers that was seeking to bolt on value-added services as a customer retention strategy. This train came to much to the frustration of the engineers at those same hyperscalers, as evidenced by the feedback from an exasperated IBM employee last week that I saw on Reddit. I quote, "Why build an innovative cloud solution when we can just acquire something decent and slap our logo on it?" Now, this becomes problematic when you're Canva and are burdened, if that's the right word, with a $26 billion price tag at a time when the path to a profitable future is challenged by increasing customer acquisition costs and larger competitors offering alternative bundled products. However, the point of this week's report is not to pick on those poor Canvanauts. Perhaps we are now in the kind of risk-on environment that will allow this ever so slightly long-in-the-tooth unicorn to finally, after 12 years, ring the bell on the floor of the NASDAQ. Time will tell. I wish them well, but please, please, no more rapping. What I think requires closer scrutiny is the path forward for the cohort of SaaS businesses that are already public. Ed Zitron recently published one of his hugely entertaining rants in which he describes the SaaS market as the tech industry's own growing commercial real estate bubble. I quote, "The tech industry's desperate attachment to AI is largely fueled by the SaaS industry, because AI is the first meaningful new thing that they've had to flog to customers in quite some time. And because so many of these solutions are sold in bulk in annual contracts signed by people who aren't the end user, AI feels like something they can put on top of another solution and claim it's new." Ed further speculates that this could result in a, quote, "race to the bottom where growth-hungry SaaS companies either deeply discount or don't charge for AI, pushing their competitors to lower the price on their already unprofitable products." Now, this is a trend that your rodent thinks is most definitely actionable. In section 2 of the letter for paid subs this week, the squirrel lays out a sensibly risk-managed plan to take advantage of the trend. You're not going to want to miss it. Get that and more regular snark at blindsquirrelmacro.com or find me on Twitter @squirrelmacro. Thanks for listening. Squirrel out.